Most entrepreneurs I meet are running on a single dream: the exit. They grind for years, sacrificing sleep, relationships, and their sanity, all for that one glorious payday when they sell their company for a life-changing amount of money. But what if I told you that for many, that dream is a fantasy? What if I told you that selling your company is often one of the worst financial moves you can make? My businesses have generated millions in value, and the single most important lesson I've learned is that the smartest people in the room don't sell their golden goose. They learn how to get the golden eggs without giving up the farm. If you follow the blueprint I'm about to share with you today, you'll discover a strategy that the ultra-wealthy have used for decades to build fortunes, a method that lets you cash out, de-risk your life, and still keep all the upside of the business you've bled for. So, without further ado, let's get into it. Let's first tear down this myth of the perfect exit. When you see a headline that says a company was sold for $50 million, you imagine the founder getting a wire transfer for that full amount and sailing off into the sunset. The reality is a brutal disappointment. That headline number is pure fiction. The actual transaction is a minefield of deductions, delays, and strings attached. First, there are the transaction costs. Investment bankers, lawyers, accountants, all taking a significant slice of the pie. Then comes the taxman, who will happily take a massive chunk in capital gains tax, often 20% or more, right off the top. But it gets worse. You almost never get all the cash at once. The buyer will lock you into complex arrangements to ensure you don't just take the money and run. You'll be faced with things like an earnout, which is a fancy way of saying you'll only get the rest of your money if the company hits specific, often aggressive, performance targets over the next few years. You might have to provide seller financing, essentially loaning the buyer money to buy your own company. And very often, they will require you to roll over a portion of your equity, meaning you have to reinvest a chunk of your proceeds back into the new company. After all of that, the actual cash that hits your bank account is a tiny fraction of that glorious $50 million valuation you dreamed of. You've given up control, your future upside, and years of your life for a number that is shockingly small. There has to be a better way, and there is. The secret isn't in selling your equity, it's in leveraging it with debt. Instead of giving away ownership of your company, you use the company itself as collateral to secure a loan from a bank. The cash you receive from this loan is, in most cases, not considered taxable income. Think about that for a second. You get a massive infusion of liquid cash, tax-free. This isn't some shady loophole, it's a fundamental financial principle. By taking on debt, you retain the vast majority of your ownership and, crucially, all the rights to the future growth and profits of your business. You get the cash you need today to diversify your wealth, reduce your personal risk, and make other investments, all while your primary asset, your company, continues to grow in value. You're effectively cashing out without selling out. To make this crystal clear, let's use an analogy that everyone can understand: real estate. Imagine you spent years of your life and all your savings to build a beautiful apartment building. You now own it 100% free and clear. It's your equity. Every month, the rent from your tenants with a steady cash flow. Now, you want some cash to buy a vacation home or invest in the stock market. You have two options. The first option is to sell the entire apartment building. You get a big check, pay a mountain of taxes, and you no longer own your cash-flowing asset. You've lost all future appreciation in the property's value. The second, much smarter option is to go to a bank and get a mortgage against the property. The bank might lend you up to 80% of the building's value. You get a huge tax-free lump sum of cash, and you still own the entire building. You still collect the rent, and you still benefit from every single dollar. The property appreciates in the future. This is exactly what we can do with a profitable business. Your company is the apartment building, its profits are the rent, and a business loan is the mortgage. You're simply using a valuable asset to generate liquidity without giving up ownership. Let's put some real numbers to this so you can see the sheer power of this strategy. Suppose your company is currently valued at $1 million. Your entire net worth is tied up in this single, illiquid asset. The traditional path says to sell it. If you sell it for $1 million and pay, let's say, a 20% blended rate for taxes and fees, you walk away with $800,000 in cash. Not bad, but you no longer have a business. Your engine for wealth creation is gone. Now let's look at the alternative. Instead of selling, you go to a lender and recapitalize the business. You decide to keep 30% of the equity and take out a loan for $700,000 against the company's. That $700,000 lands in your bank account tax-free. You still own a 30% stake in your company. Now, Let's fast forward a few years. Your hard work pays off, and the company doubles in value to $2 million. Your 30% stake is now worth $600,000, so your total net worth is the $700,000 in cash you already took out plus your $600,000 in equity for a total of $1.3 million. Compare that to the $800,000 you would have had if you'd sold. You are $500,000 richer, and you still own a piece of a growing asset. This is how leverage doesn't just give you liquidity, it dramatically amplifies your potential for wealth. So how do you actually do this? There are several common structures for this kind of transaction. The most straightforward is asset-based lending, where you use your company's assets like accounts, receivable, inventory, equipment, or even the equity itself as collateral for a loan. Another powerful method is called a dividend recapitalization or dividend recap. In this scenario, the company takes on debt and then uses that borrowed money to pay a large, one-time special dividend to you, the shareholder. You get a massive cash payout, but your equity percentage in the company remains exactly the same. For more complex situations, you might consider a minority equity sale, where you sell a small portion of the company to an investor and combine that with debt to get an even larger sum of cash while still retaining majority control. Each of these structures has its own pros and cons, and the right one for you depends on the size of your business, your cash flow, and your specific goals. If this sounds like some niche, high-risk strategy, it's not. It's precisely what the wealthiest people and the most sophisticated executives in the world do. Think about the CEOs of massive public companies. When they want cash, do you see them selling off huge blocks of their stock? Rarely. Selling signals a lack of confidence and triggers a massive tax bill. Instead, they go to a private bank and take out a loan against their stock portfolio. They get the cash they need to live their lives or make new investments. Their stock continues to appreciate in value tax-free, and the interest rate they pay on the loan is often far more favorable than the capital gains tax they would have paid. They are playing the game of wealth, not the game of income. This brings us to one of the most important benefits of this strategy: de-risking. As an entrepreneur, it's likely that 99% of your net worth is tied up in your company. That is an incredibly fragile position to be in. Your business is a high-risk asset, vulnerable to market shifts, new competitors, or 1,000 other things that could go wrong. Using debt to pull some of that value off the table and into other, more diversified assets is one of the most responsible financial decisions you can make for yourself and your family. That tax-free cash can be used to buy real estate, invest in a diversified portfolio of index funds, or simply build a substantial emergency fund. You are locking in a portion of your hard-earned success, creating a safety net that protects you from the inherent volatility of running a business, all without having to walk away from the company that has the potential to grow even more. So, what are the practical steps to start this journey? First, you need a clear-eyed assessment of your company. Second, you need to start talking to the right people. This means commercial banks, specialized asset-based lenders, and private credit funds. They will tell you what's possible, including how much they're willing to lend, the loan-to-value ratio, and at what interest rates and terms. Third, with this information in hand, you can work to choose the right debt structure for your goals. Whether it's a dividend recap to fund a diversification strategy or an asset-based loan to fuel an acquisition. Fourth, and this is non-negotiable, you must assemble a team of experts. You need an accountant, a tax advisor, and a lawyer who understand these types of transactions inside and out. They will ensure the structure is optimized for tax efficiency and is legally sound. Finally, you execute the plan, monitor your debt covenants, and as your company's value grows, you prepare to refinance and do it all over again. Debt is a powerful tool, but it's not free money. You will have to pay interest, and you will be subject to covenants, which are rules that can restrict how you operate your business, such as limiting future spending or other transactions. Taking on too much leverage can be dangerous. The complexity of the tax and legal implications means that a poorly structured deal could end up costing you more than you save. It is absolutely essential to work with experienced advisors who can help you tailor a solution that fits your specific situation and risk tolerance. Ultimately, this all comes down to a fundamental shift in mindset. You need to stop viewing your company as a lottery ticket you hope to cash in one day. Instead, see it for what it is: a powerful, long-term asset that can compound in value over time. Your job as its manager is not just to grow it, but to manage it wisely. Don't use the sledgehammer of selling the entire company to solve a problem that a more precise tool, like intelligent debt, can handle. By learning to use leverage, you can access liquidity, reduce personal risk, and enhance your capital efficiency, all while holding onto the engine of your wealth. It's a marathon, not a sprint. The goal isn't a single explosive exit. It's about building sustainable, multi-generational wealth. Focus on consistency, smart financial engineering, and outlasting everyone else. That is the true path to financial freedom.